debt equity ratio. What does this ratio tell us? As the name suggests, it is a ratio which gives the relationship of long-term funds as to the equity, and by equity we mean shareholders' funds. So this ratio tells us about the degree of indebtedness of an enterprise. Like for example, let's say ratio is 0.75. That means our long-term debts are around 75% of shareholders' funds, and by shareholders' funds we imply the funds invested by the owner. Then it also gives us the status of the outsiders' funds as compared to the owner's funds. So students, let us come to the formula of debt equity ratio. The formula for debt equity ratio is debt equity ratio is equal to long term debts upon equity, and in some cases equity can also be referred to as shareholders funds. Now students, by long term debts, that is the first component here, what we mean is debts which are there in the business for a period of more than 1 year. So what does long term debts include? Long term debts, they are equal to debentures plus mortgage loans plus bank loans which are secured and for long term period plus loans from institutions. By loans from institutions we understand that there are lots of financial institutions like UTI, LIC which lend on long term basis. So when we take loans from these institutions, we will put that as loans from institutions. Like UTI, LIC and so on. Names might be given. So now students, plus we can put dash dash, that is there might be some other form of long term loans if given in the question. So by long term debts we mean those debts which are for long term period, that is more than 1 year. They include debentures, mortgage loans. Obviously debentures are also mortgaged, but by mortgage loans we imply loans which are not in the form of debentures. Then bank loans, then loans from institutions like UTI, LIC and so on. So all the sum total of all these is equal to long term debts. Now coming to equity, shareholders funds. So this includes share capital, now students remember it includes both equity and preference. Then reserves, that is both revenue and capital, and those capital reserves like security stream which ultimately belong to the shareholders. So we have reserves and surplus minus any fictitious assets that are there. So they have to be deducted. So students, shareholders funds include share capital which means both equity and preference, then reserves and surplus which includes both capital reserves and general reserves, and remember those capital reserves like securities premium which actually belong to the owners, and fictitious assets to be deducted. By fictitious asset we mean miscellaneous expenditures which have not yet been written off, like discount on issue of shares or discount on issue of debentures and underwriting commission not written off. So when we have the total of long term debts and equity, they can be divided to find debt equity ratio.